Hello, everyone, and welcome back to the latest episode of Real Take Real Estate with the Joseph team, where we give you our real take on today's housing market and everything to do with real estate. I'm your host, Maddie Maloney, followed by my co-hosts,
Joe Sambear
and Sam Fada.
So today we are talking about the exciting topic of home equity. Now, home equity is at an all-time high right now. So today we want to talk to you about why equity is up, tools to tap into equity, some smart strategies on how you can utilize that equity, some best practices, and then some real life case studies. So a lot to talk about today, but this is something that we feel like not a lot of people really know. You know, you have that equity sitting there, which is great, but people don't really know how they can best utilize this to their advantage. And there's lots of ways that you can utilize your equity. So first, why equity is at an all-time high. Right now, U.S. homeowners hold about $32 trillion in home equity. 60% of borrowers have about $100,000 in tappable equity. Now, tappable equity, that means that you can't tap into pretty much all of your home equity. You know, when you're looking at doing a cash out refinance or a home equity loan, you can't take out everything that's there. Typically, you can go up to 80% or 90% of the combined loan to value, but still, even with that tappable equity, most people have $100,000. So we're going to talk about how you can best utilize this and what that looks like as well. A couple of other facts: home equity lines of credit and equity loans use, those are rising as well right now. Originations for those are up 7.2%. Debt consolidation is up right now 39%, while renovation use for home equity lines of credit has declined from 46% from 65% originally. So equity is a real opportunity to finance for financial leverage. So first, Sam, I wanted to talk to you about some of the tools that we can use to tap into this equity. You know, people have this available, their home, they bought their home, the home value is appreciating. How are people going to be able to really utilize this? There's going to be 3 different methods. Can you go over those couple of methods?
Yeah, absolutely. So the first one being like a cash out refinance where, you know, replace their current mortgage at a new interest rate. Second one, there's a couple different types of home equity loan options, which would be mortgages in addition to the current mortgage that they have on the home. And then, they'd be looking at the third option, a home equity line of credit or a fixed rate and term, number 2. So those are the 2 different kinds of options there. The first one, why you would be looking at doing that, maybe you're looking at debt consolidation or something along those lines. The, average consumer doesn't realize that they can leverage that equity in their home. And the reason why that's up, the last 5 years, we've seen such an increase in home values, over that time period, created that equity because the market, naturally went up in value. And so all this equity being there, is available to consumers to, change their cash flows each month and pay off some high credit card debt, and, do home renovations and those kind of things. So that's a lot of the reason you can tap into that equity.
And a lot of what I've been hearing lately, a lot of people in 2020 during the refinance boom, they secured their low rate in the 2s or the 3s. And oftentimes we hear, well, I don't want to do a full cash out refinance. I don't want to give up that great rate. Well, you may also have that credit card debt that has that interest rate in the 20 to 30% that, when you look at the total cash flow that you would be saving by paying some off, even though it is going to be a higher mortgage rate, the savings are just crazy when we're looking at it sometimes about, people really don't want to give up that rate. But when we lay it out, when you pay off these credit cards, here's how that changes. It's really just thousands that people are able to save that they really didn't realize before. So there's definitely opportunity there, especially if you have high debt in the high interest rates. There's lots of opportunities that you should most likely try to check out.
And some of that too is like the credit card debt in the country is at an all-time high right now as well. So people, like you said, Maddie, that have those 2 and 3% mortgage interest rates, but struggling making ends meet because they're making minimum payments on $20,000, $30,000, $40,000 worth of credit card debt. If you're paying $1,000 per month in credit card debt, but combine them all onto a fixed rate 30-year note, even if it's at a higher interest rate than 3%, you can always pay extra on the mortgage, and you can position yourself to, save $700, $800, $900 a month that you're throwing at these credit cards and just stuck on a hamster wheel, basically.
Well, and we have cascading other expenses coming in. I mean, obviously credit cards, but we're seeing auto insurance and homeowners insurance increase.
Property
it's a
taxes.
lag from the last few years.
Oh yeah.
Utility bills. There's a lot of inflationary things that are still continuing to come in that are under control totally yet.
So, couple different ways that you can tap into that debt. As Sam mentioned, you have the cash out refinance, the home equity loan, and a line of credit. So, some different ways there. Now, let's get into how you can smartly use those funds. So you have this equity, you've started the process for either cash out refinance or line of credit. Now, what is going to be the best way that you can use these funds? So Joe, can we go over a couple different ways that is going to be most beneficial for borrowers, not just to have these funds for, vacations or something
Party
like
time.
that. That's not really what you want to use these funds for. There's some really great ways to benefit you.
Absolutely. And, just to start with, there's a delicate balance between tapping into your home equity or leaving the equity just sitting there. And so we always have to be really cautious of, like you indicated, what are we using those funds for? Is it just short-term, a little short-term in nature? Like you said, spending that's not really changing the overall financial picture over the long term. That's probably not a good use of equity. But it also doesn't make sense to have hundreds of thousands of dollars of equity sitting there and you're struggling on this other side of the ledger
exactly.
and not putting yourself in a comfortable position. So there is a balance there that we always try to make sure people understand, using equity in your house there is a risk because it's your primary home. We don't want you to lose your primary home. So we take that really seriously. But there's some, if you keep the right amount of equity, the right amount of loan to value, not over leveraging. One great way is like obviously the debt consolidation. We talked about that. So credit cards are 20% plus. Let's bring those in. Maybe some people might have to close them out because maybe it's too much of a temptation
like
to
financial,
spend. Too much temptation.
Yeah.
So if you feel like that's the case, maybe we consolidate them, close them. That might be a good thing to do in this case.
That's definitely one of the risks that we do like to talk with people as well. This is not just kind of a one-time fix, let's pay these off. Now you can go and max out your credit cards.
Don't let it pile up.
That is not what we're trying to do here. We're trying to consolidate debt so that you have that lower payment now. But then we also like to talk about the future. Okay, let's make sure that we are paying off our credit cards each month. Let's put ourselves in the best position for this. Because if we pay it off just to go back and max them out, that is not going to be setting you up for a good situation in the future.
And then if you maybe previously used a home equity line for a renovation or maybe some debt consolidation, and we talked about having a 3% mortgage, well, maybe this is a good time to take the 3% mortgage, take a large home equity line of credit that you might be paying 7 or 8%, maybe consolidate that on a 15-year fixed and like retire both of those things. This is a good time to review that as well as we move forward this next year. Obviously simplifying the monthly payments so you can get a routine of savings. And what we find in personal finance, I think is very true, is habits. Habits of automatically doing things, automatically saving for your 401k that comes right out of, you don't even see it. It comes right out of your paycheck. Same concept. Set up, let's get all this debt consolidated, set you up for automatic payments. Maybe we even pay more than your minimum.
Overage,
Maybe we pay a few $100s more. Take the same amount of money you were paying to those credit cards, add that on top of your mortgage payment, on top of your minimum, and get that equity back rolling. So there's some just simplifying, repeat, those kind of automatic things can really help people.
Absolutely. And a lot of it too, one thought I had is with the home equity line of credit is, if you think you may be moving in the next 3 years or starting a family 5 years, what have you, and you have 150 grand in equity or even 50,000, doesn't necessarily matter. It's very inexpensive to establish that home equity line of credit on your home. And if you don't borrow anything against it, you don't have a payment. A lot of times there may be a minimal annual fee, but then you have that safety net there to be able to move up into the new home to leverage that equity simply to put it down on the new home. So in advance, using it sort of like a bridge loan to be able to have access.
That brings us into our next topic, the move-up purchase. So
that.
The move-up purchase, like Sam said, presenting yourself, if you know, okay, I'm looking to get that next house, maybe it's a little more expensive house, having that line of credit already established, or I'm going to buy a second home, investment property, having that line of credit established and ready to roll is an excellent way to do the move-up purchase. Yeah. We are seeing a lot of examples of people being able to take that equity, buy a much more expensive home, use all of that equity as down payment. It's a great thing to see.
Yeah,
we're also seeing, we've had several examples recently where they've considerably moved up, paid off debt, and even with higher interest rate environment comparatively to 3 or 4 years ago, we've seen people actually cash flow about the same.
Yeah.
So the mortgage payment goes up dramatically, but because they're able to pay off some debt in the process, we've seen people come out in a really good position.
Oh, yeah.
So the move-up purchase. And then lastly, renovations. One of the risks of renovations is you get into the middle of a project, a kitchen project, for example, you tear out a cabinet and find out there's some issues. And the number one issue I see, and we've seen over the years with construction renovation, is really not having the resources available during the project. Thinking you're going to have enough in savings, or thinking you're going to have enough and not having enough for those things that just usually come up, or an improvement you want to take advantage of during that construction. So having that home equity line available and ready, even if you're not going to use it, is very wise.
And we've definitely seen a lot of people use these funds for renovations lately, in the higher interest rate environment. And since there's not a whole lot of homes available right now, more people are kind of making their current home into their forever home and adding these renovations to increase their home value and also just increase their livability in the home, add some different features that maybe they wanted in a future home, but hey, you have this equity available now. You can make your own home your dream home and add on those couple of features that you want. So it's just easier now to be able to do that, to tap into the equity. And then, down the road, that also helps. Some of those improvements will help for you to be able to sell that home because you've already made these renovations.
Future value with it, too. You're investing your own equity into your asset, which can help create more equity in that sense, too.
Absolutely. So a couple of smart uses that we went over: debt consolidation, move up purchase, using that equity for the future down payment, and for renovations. So three great ways that we can be able to use that equity. Now, let's go over, it's always great to use it, but there's always going to be some risks. There's some pros, there's some cons. Let's go into that because we want to make sure that you have the full picture when you're doing this. We don't want you to go and take on additional debt, just because. We want to make sure that you know everything that will come with it. So there are some risks when we go through tapping into some of the equity. So Joe, can you go over a couple of the risks that borrowers should just be aware of when going through this process?
Yeah, the first one is your home is collateral. So, obviously, if you default on your home, it's different than defaulting on your credit card. If you default on your credit card, the creditor can go after and garnish wages and file a judgment. And that's there's not much more that can happen there. When you get in a bad position in your home, you're really putting your future at risk in your housing. So you have to. That's very serious. So it's changing the risk level of the debt. I think that's important to know.
Because that's when we said, when you're doing some debt consolidation and you're freeing up those, credit cards now after we've paid them off, we're not going to go and max those out again.
Yeah, exactly.
We really want to change the thought process as well in your financing process. But if that doesn't change, that does become a risk down the line. Yeah. So making sure that all right, this is not a fix all. I can go back using my same habits and spending habits. We got to change our thought process as well with that.
And on the credit card stuff, obviously I think it's pretty well known that closing credit cards doesn't help your credit score per se, but there definitely are people that should close their credit card.
Yeah.
I mean, there are
Sure.
situations where even though that might not be the best way to optimize your credit score, it might be the best thing for your personal finance.
Yeah.
And that's just short
Sure.
term.
Short term. Use, and you can use other things like get a debit card. I mean, if you feel like you need the for security purposes and ease of use, there's other ways to establish that. Asset-based credit cards where you actually are leveraging a savings attached to it. There's other ways to accomplish those
And then
goals.
you can always request a lower credit limit too from creditors.
Yep,
so
absolutely.
then, it's still keeping it open, trying not to use it obviously, but then limiting yourself with that credit limit.
Yeah. And I think one thing that I think people don't think about is just even when they first sign up saying automatic pay off just setting up their automatic payments right from the get-go of I'm going to set this to pay off the full balance every month. And you'll kind of not get into that position.
Yeah.
And that's just a simple thing of a habit of doing. The HELOCs and closing costs, and the one thing you do have to be cognizant of is even though this sounds appealing, like, oh, I'm going to save $500 a month or whatever the case might be with debt consolidation, you still have to look at what type of loan is this? Am I getting the best interest rate? Are these fees appropriate? Is some lender saying, oh, you're going to pay $15,000 in fees to get this rate to consolidate to your debt? You still have to be paying attention to the details. Don't let that payment decrease make you not look at those other details, because that's critical. Same with HELOCs. HELOCs can vary from bank to bank, so you should be looking at that, and the fees can vary dramatically from bank to bank. So I think that's pretty much it as far as we've talked about some of the risks. And I think really making sure a couple key things to do or best practices would be to, again, don't leverage too much. Make sure you keep 20% equity. I think that's a healthy amount of equity. Can you handle the higher rates on a HELOC if prime is heading downward right now, but if it does go up, are you comfortable with that? Or do you need a fixed second mortgage where you're just paying principal and interest in? Home equity lines, you're just paying minimum payments. So you have to be very disciplined about paying extra. If you're not that type of person, which is fine, I think it's good to get a fixed second mortgage so you're forced into paying principal and interest. That's a healthy thing. And make sure you keep enough savings around during all of this in case there's emergency. And I think just carefully consideration of your finances and getting with someone, whether it's your financial planner, your banker, someone you really trust that's done really well in finance, to look at the whole picture. Because I think one of the things that's unfortunate in our society is there's no one really looking at your overall financial picture. You have your tax preparer, they're just looking at the tax return. You have your financial planner, they're just looking at your investments. You have your, maybe at work, there's someone that helps with your health benefits and insurance. But there's really no one that's looking at the whole perspective. And I think that's kind of a dangerous thing.
Yeah.
So hopefully we can
Absolutely.
help you put you with professionals and take a more comprehensive approach to what's
And when
happening.
looking at that whole picture, that really comes into play when you are looking at doing a refinance, because you got to look at, what the break-even point is when you're including the closing costs in there. And then also, if you're only going to be staying in the home for a certain period of time, does this even make sense? Maybe it is a lower payment, but with the costs that were in there, maybe it doesn't make sense at that point. So talk with your lender. Talk about what that break-even point is. You'll actually be making these savings after a year, 18 months, something like that, making sure that they know as well and that they can talk with you about what is this full picture, when are you actually going to be saving money, and how do those closing costs play into it as well. So that's a little bit about the risks and best practices as well. Now we also have, a real life scenario. So let's say we have the Johnson family. So the Johnson family has a $400,000 home with a $200,000 mortgage. So they have $200,000 in equity. Now the Johnson family also has $25,000 in debt. They have credit cards at a 22% interest rate. They also have an auto loan at a 7% interest rate. They also wanted to include a kitchen remodel that is about $20,000. So they're looking at borrowing $40,000. Now with the new loan, if they do a cash out refinance to put all of this all together, they're going to be able to lower their monthly interest, improve cash flow, and also increase the home value with these renovations as well. So they could still have $80,000 of unused equity, so they're not maxing themselves out, but they are being able to, consolidate that debt, use that equity for improvements as well to put themselves into a good position. So we run into this all the time where people are like, I really don't know if I want to get rid of that equity. Well, let's help you make that equity work for you. And it's not just going to be short term. These are going to be long-term investments where it's going to help improve the value of your home. You're going to be able to, free up some of your spending because we're paying off those credit cards to really put you in a great position. And I think that a lot of people would be able to relate to this situation and maybe start thinking about, all right, I do have this equity. Should I be using this instead of just letting it sit there? How can I best use this for myself to set myself up into a better position in the future?
Yeah. And that's a lot of it too, is like people think, I don't want a second mortgage. I want to pay my house off this and that, but a mortgage really, in essence, if you have all this other debt, struggling to make ends meet month to month, a mortgage really is a financial tool in that with equity at an all-time high in your home, there are solutions to position yourself. So, I mean, even if you do have that low interest rate on the first mortgage and you're shelling out all this money on these other debts, you can combine them, have better cash flows, and then you can stash those additional cash flows into savings to grow your portfolio and have a cushion there with future cash, basically.
And even in this little example with $25,000 in credit card debt, in the savings, easily, conservatively, you're talking about, just on the credit card debt alone, you're talking about $10,000 in overall savings in the first 5 years. Easy. That you now have, that was not paid out to another bank.
Exactly.
That you can put in your own pocket. So,
yeah.
Absolutely.
Great point.
So those are some great examples of tapping into your equity. So on today's episode, we have learned about why equity is at an all-time high, some different tools to be able to tap into that equity, whether that be a cash out refinance, home equity loan, or a line of credit. We've also talked about some smart uses, the risks and best practices, and some real life examples. So hopefully this episode was helpful. If this relates to you at all and you want to know how best to use your equity in your home or see how we can help put you in a better position for your future, please do not hesitate to reach out. We are always happy to look at your full financial picture to see how you can use your equity to set yourself up for success. So that was it for today's episode on Real Take Real Estate. We hope you enjoyed it, and please don't hesitate to like, comment, subscribe if you liked today's episode, and we will catch you next time. Thank you so much.